Welcome back to Upticks, the podcast where smart investors get sharper. I'm Jake Falcon, the founder and CEO of Falcon Wealth Advisors and your host of Upticks. And I'm joined by my permanent guest and co-founder of Falcon Wealth Advisors, Cory Bittner. Cory, welcome to the show.
Jake, thank you for having me.
Cory, for our audience this week, we're unpacking a mix of monetary policy, consumer resilience, and corporate strategy, all through the lens of what it matters to their wealth. And so if you're a high net worth investor, a retiree managing income, or you're a high earner and you're not rich yet and you're building your financial future, this episode this week, Cory, is designed to help make sense of some of these urgent signals going on. Before we dive in though, Cory, quick commercial. I want to thank our audience. Please subscribe, 5-star, thumbs up, like, and share our content. I think that helps the algorithm get Upticks to more people. The whole point of Upticks is to enhance financial literacy. Also, if you are in our audience and you want a free copy, that's right, FREE, Cory, free copy of my best-selling book, Retiring Right, Smart Steps for Exiting Corporate America. Check it out in the show notes. You just fill out a quick form and you can get free 150-page ebook version of my book. It's also out there if you want the physical copy or the audio version out there on Amazon. All right, Cory, how about that intro?
I like it. Strong intro, Jake. Well done.
Thank you. Thank you. Let's dive in then. So the Fed signals further easing, Cory. So the Federal Reserve cut interest rates by 1/4 point last week, bringing the benchmark rate down to 4 to 4.25%. Officials have hinted at 2 more cuts before year end, citing concerns over slowing job growth and persistent inflation. Cory, why don't you talk about why this matters to our audience, and then we'll give our takes.
Yeah. So why this matters, but the real impact, right, is that so borrowing costs are coming down. That's first and foremost part of what's happening here, which can be helpful as far as mortgages go, which aren't tied directly to the Fed funds rate, but refinancing, there's an impact, of course, on the stock market. That's why all of this matters. But it also is the fact that the Fed is telling us they see some weakness, right? That's why they're lowering rates. They see inflation remaining a little bit persistent. But a big piece of what matters here, Jake, is that if you have a lot of cash sitting in a savings account or money market account, the interest rate that you earn on that cash is going to move lower.
Yeah, on fixed income, you're right, Cory. And even if you have bonds, so if you're buying bonds, the rates or the yields on those bonds may be lower. So this show is not advice, but this is one strategy that we deploy for our clients. This is why when we buy fixed income portfolios for our clients, we ladder maturities. You see, you don't want to put $1 million in a 1-year CD and that be your fixed income strategy, because what happens is if and when that CD matures, and if the Fed has lowered rates, well, now when you reinvest, it's called reinvestment risk. When you reinvest that money back into a new CD, that whole $1 million is going to be making less interest than the old $1 million. And so we ladder maturity. So we have maturity going 1 year, 2 year, 3 year, 5 years, typically out 10 years. So that when you do have bonds mature, and if rates are lower than when you first bought the bond, well, now your whole portfolio isn't susceptible to this interest rate risk. So here's my take on it though, Cory. So this is a pivotal moment. The Fed's tone has turned much more dovish. And while political tensions are still rising, the market's likely to determine this as supportive. And so I think this is and again, this is not advice. You should meet with your financial planner if you want investment advice, one-on-one here. But I think this is a green light to consider selective risk-taking. But again, you got to watch that inflation data, because if inflation starts getting worse, like it has, if it keeps getting hotter, they won't cut rates. They in fact may raise rates. And so it's a juggling act for the Fed. My big deal is don't fight the Fed. I know, Jerome Powell has a very difficult job. I actually think he's done a really good job weathering the storm and deciding when to cut and when not to cut. And the reason I think he's done a good job is to look at the economy. The economy is doing extremely well. Inflation is way down, Cory. Employment is still below 5%. To me, that means the Fed has done a good job. Do you have your take on this, on Jerome Powell? You hate Jerome Powell, Cory?
No, I think that...
You hate him?
Do I hate him? No,
you hate Jerome Powell?
No, I don't hate him. I don't even know him. But I think that this speaks to the challenge of the Fed, right? So they're trying to control inflation, but also economic growth, right? So it is a challenge, no doubt about that. The Fed's choice to cut rates here, it's because they do see, they see some growth weakening, a little bit of a slowdown. There's still inflation. I think that you did a good job of highlighting it, Jake. But I think that at the end of the day, if you've been waiting for interest rates to move lower, that has begun. It's a great time to revisit your plan, revisit your strategy, and recognize that just leaving money sitting in cash and waiting is not really a plan.
Good, good. All right, Cory,
That's
let's
my
go on to the
take.
next one.
Mortgage refinancing hits highs. Mortgage rates dropped to their lowest level since October of 2024, sparking a 58% surge in refinance applications last week. Adjustable rate mortgages, or ARMs, rose to 12.9, almost 13% of total activity, the highest share since 2008, while the average refinance loan size hit a 35-year high. Despite economic uncertainty, homeowners are seizing the opportunity to lock in savings. Why don't you tell me, Jake, what do you think matters here? Why does this
Well,
matter?
this is a big deal. It's a big deal for homeowners looking to lock in savings. So, for high net worth investors, it's a signal that liquidity is being unlocked. And for retirees, it might be time to revisit mortgage terms or consider downsizing if you've been waiting for mortgage rates to go lower. Now, the deal here is, Cory, mortgage rates haven't plummeted, but my mortgage guy just reached out to me and he said I can get an ARM as long as my loan to value is 75%. I think he could get me an ARM in like the fives. So that's not a bad deal, right? Compared to like when I bought my house, it was in the sevens. And so you're right. It has moved quite a bit. But I want to be clear here. Just because the Fed lowers rates doesn't mean the mortgage rates are more predicated on the 10-year yield, not the short-term rate. So the Fed controls the short-term rate, the overnight window of what banks can borrow at. They don't control at all, Cory, the 10-year yield. And so my point is, even though the Fed lowered, mortgage rates could go back up, and that very well could happen. And so you just want to be on top of it. Now, again, this is no rule, but I personally like to save over 0.5% or ideally 1% if I'm going to refinance, because there are fees associated with refinancing. So if you are looking at refinancing, make sure that you do an adequate break-even analysis, meaning you need to figure out, yeah, it's great you're getting a lower rate, but how much dollars in fees are getting rolled back into your mortgage, and how long is it going to take you to pay back those fees? So my point is, you might refinance, but the break-even might say, well, you have to live in the house 3 years for this to make financial sense, for you to actually recoup the fees that you just paid. So just be aware of that. Don't just go refinance every time you can, because there are fees associated with it. So the key here, Cory, is just to review your mortgage. If you haven't done it in the last 6 months, now's a good time to do it. Rates are, I don't know if you want to say rare, but the market's responding. So the market has shifted. Obviously, people have jumped on this and more people are refinancing. So just don't ignore it. And, again, meet with your financial planner first, and then let's crunch the numbers and see what makes sense for you and your family. You got more of an opinion on this one, Cory?
Yeah, I think actually, I think it's interesting, Jake, that you said your mortgage guy reached out to you about an ARM. I know that you refinanced. I think you told me last year. Just recognize that there's risk, right? Obviously, with an adjustable rate mortgage, the rates, you might get a lower rate now, but you might have higher rates later. It's
Yes.
just impossible to say. So I think that, my point of view is that people are refinancing so they've got more breathing room as far as cash flow and budgeting goes, which makes sense. And it's smart to reevaluate that. But the fact that ARM adjustable rate mortgages are what's really spiked. I think people just want to be careful. Don't try to get too cute there because there's risk involved. I think the interest rate or the refinance loan size being at a 35-year high speaks to the state of the housing market and home prices. So if you can take advantage of this and it fits in your plan, I think that's great. But don't try to get too cute as far as, shifting a fixed rate to an adjustable rate, expecting that rates are just going to drop in perpetuity.
Yeah, good point, Cory. Yeah, that's good. I already have an ARM, and maybe that's why he said that. So I don't want to suggest that he was encouraging that. I think
Got it.
he already have one. And
I didn't
so
realize that.
I got an ARM because when I got my house, it was like 7.5%. And I'm like,
Right.
yeah, I'll do an adjustable rate. So you're right, though. I might lock it in, but you just have to understand the risk that you're taking with an ARM.
Yes.
And you have to play an active role in your mortgage if you have an ARM. Lucky for me, Cory, I happen to be in finance.
That's
so
right.
I don't mind playing an active role in my mortgage, but this is not for somebody that's passive. It's not for somebody that's risk adverse, and it's not for somebody that's on a fixed income. I don't think ARMs make sense for those people.
Yep.
Right.
That's good.
I happen to still be working, and I have a good cushion of savings where if my rate did adjust up, I could handle my mortgage payment. Right. So that's a reason though that I do the ARM. I didn't do the ARM on my first house because my first house, the rate was like in the threes. So I wouldn't do an adjustable rate when it's in
Right.
the threes,
Lock that in.
but I would do it when it's in the sevens. All right, good. Let's go to the next one here, Corey. August retail sales surge. So, Corey, despite economic uncertainty, the U.S. retail sales rose 0.6% in August, which is that's right, triple what economists expected. Online and apparel spending led the way with strength concentrated among higher income households. So this matters, Corey, because consumer spending drives the economy. And the resilience suggests that wealthier households are still spending, even though the hiring or the unemployment number is ticked up a little bit and the tariffs begin to bite. So, what is your opinion on this one, Corey?
Yeah, I think that the fact that retail sales have surged the way they have, that helps the consumer's resilient sort of narrative, right? Which can help support markets and GDP. The reality is uneven, just as you highlighted, that wealthier households are driving the numbers, lower income households are stretched more thin. So I think the fact, recognize that it's split. Higher income households have the money to spend, but lower income households are, feeling the squeeze. For our clients, the takeaway is that you don't want to just get distracted by headline data and what comes out. I know, like you mentioned, Jake, this was triple what the expectations were, which just speaks to how often economists can be wrong when they try to
Yeah.
predict the future, Jake. But yeah, you don't want to get distracted by that. It also doesn't mean that the economy is bulletproof. The reality is you just want to build your plan so you're on the stronger side of that divide.
I've got a philosophical question about the
Mm,
polarization of America, Corey.
mm. All right,
Because
bring it on.
so what's happening is, this is weird to me. So the high net worth or the high income earners or the high tax bracket people, basically what this is suggesting, are carrying the US economy right now because they still have purchasing power and they're still spending and shopping. Those people also pay way more in taxes. So my thinking or my question to you is like, so, and I don't think this is right though. So would the argument be though that you'd want to protect that class of people because they are actually they're helping everything keep propped up? Because I think a lot of times people want more income equality and they want to knock those high income earners down a little bit. But my point is, the way it is right now, they're paying the most in taxes and they're driving the economy for America. So those are actually two good things that these wealthy people are doing. So why do they get knocked on sometimes by liberals or the Democrats? Like why is that such a bad thing for these people? Do you have a thought on that?
Yeah, you are raising a good question. I think it just boils down to a difference of opinion that a lot of people are going to have around this. But what you're talking about, Jake, is the facts. It's the fact of the matter, right? We know what's
Right.
actually driving things. So, I think the idea that a redistribution of wealth, right, from people that have more down to people that have less is popular in some political circles. It's not popular in others. That's not very capitalistic by nature, right? In terms of the country that we live in and the way that things go. But I sometimes try to zoom out and think about this myself, Jake, and I think this is probably the way that it's always been. I do think that it's probably exasperated to some extent now. The fact that people that have money invested in the markets, we know that markets have performed well. The wealth effect is real. People are comfortable spending more money when they feel like they have more money, when the stock market is surging. But the reality is, for people that don't have as much income, they're not contributing the same to the economic growth. People that are living to paycheck, it's just more of a challenge for them. I think it's probably always been this way, but I don't think that just trying to take resources away from people that have them to try to redistribute them is the proper answer. I don't think, but I
Right.
recognize that is that's a political argument that's being made. But I think policy and the markets sort of drive a lot of this. And I think a lot of it's probably the way it's always been.
And and I don't want to punish successful people.
Right.
That's my issue with it. It's like, you know what? And I think if you go throughout history, it is the easiest to make money in America, that it's the most easy that it's ever been to make money in America right now because of the gig economy. Corey, where's my phone? We all have this powerful computer in our pockets
Yep.
every day.
Yep.
And there's so much you can do and learn. Heck, if you use AI and you just type in there, give me 100 ideas for a side hustle on how I can make more money, right? I mean, it would come up with an infinite, like it could just keep going and going and going. So I think the key here is for people to feel empowered that we live in an amazing country. And if people are in that lower income, you have the opportunity to dig yourself out of that and make more money. You have to have that spirit and that drive to want to do it. But I just think it's interesting that like sometimes the wealthy people get knocked on, and to me the facts are they're propping up the economy and they happen to be paying the most in taxes. So like I don't think my point is I don't think wealth should be something to feel shameful for. Is what I'm getting at.
I
Like
agree.
there should be no shame and people shouldn't be picking on those people because they're successful. I think you should feel empowered that like get on your phone and go on ChatGPT and figure out how do I make more money? This is me. How do I make more money? Or how do I, or go seek
Got
out
to
a
ask the
financial
question.
planner. Yes, you got to ask the question and go seek out a financial planner. All right, good. All right, good. I didn't think I would go there when we're talking about August retail sales, but there we went.
Yeah, well,
All
and
right,
it's real quick though, Jake. I also think
sure.
it's interesting though. We just talked about mortgage refinancing, right? How that has
Hmm.
spiked right before this, and adjustable rate mortgages have spiked too. Again, I think it just speaks to the bifurcation that you're highlighting here. Is that there are people that have plenty of money to spend, and there's also a lot of people that are looking for breathing room in their cash flow. The reality though is that you and I aren't going to be able to change that whole dynamic, and I don't think we have all the answers either. But if you're watching this at home and you're trying to get yourself on the right side of that, ask the right questions. Think about what it is that you need to do to put yourself in the right position, because no one else is going to do it for you.
Yeah, that's good. All right, what's the next one?
All right, Jake, TikTok's future in flux. A framework agreement for TikTok announced last week is expected to close within 30 to 45 days and will include both new and existing ByteDance, the parent company, investors. The deal follows a congressional mandate requiring ByteDance to divest from TikTok's US
What is
operations.
ByteDance? What is ByteDance?
It is the parent company. It's the Chinese parent company to TikTok.
Got it. Are you on TikTok, Corey?
I'm not.
Do you don't even have it?
No, I don't.
I don't either. All right, go ahead. So go ahead.
Yeah, so there was a congressional mandate requiring ByteDance to divest from TikTok's US operations or face a ban. Oracle will retain its cloud partnership with TikTok while the final structure remains confidential and relatively small in scale.
All
What
right, so
matters
this
here, Jake?
matters. Yeah, so this matters because basically tech regulation is evolving. And for investors, the deal could impact valuations, user growth, and platform stability. So this is not, again, this show is not about which stocks to buy or not. The key headline here is to understand that the regulations on these huge social media stocks and companies is going to change. And it frankly needs to change, I'm sure. So you just have to be careful as an investor to not go all in on something that faces a political risk. This is basically political risk or legislation risk. And so that's why you want to have a diversified portfolio and not get caught up in the hype of whatever the new shiny thing is because uh, things change, bureaucracy plays out, and this could severely impact TikTok one way or the other, or Oracle for that matter. And so you just have to stay diversified in here. So my opinion, and I want to hear your opinion, is that this is a geopolitical chess move,
Mm-hmm.
and I think TikTok's future is still very uncertain. And the structure does suggest there will be maybe some compromise, Corey. But I'd be cautious on this stuff. Like we also call this headline risk. We try to avoid that generally in our portfolios with our clients because you don't want, frankly, I don't want as a wealth advisor my clients' stocks in the newspaper every single day.
Right.
Like
Yeah.
you don't really want that because it'll whipsaw. And our clients are typically high net worth investors. They're not trying to shoot for the moon. Maybe on a few positions, but like we want to stay diversified. And so again, the key here is just not get caught up in the hype. Things are changing. I don't even have TikToks. I don't really know what the hype is about. I'm sure it's great. It's not for me. My compliance doesn't let me use it or whatever for business, so that's why I don't mess around with it. But I don't know. What's your opinion?
I think the whole thing is more about the United States and China decoupling. The globalization trend that has been intact for a couple of decades is starting to splinter. And I think that there's companies that are going to adapt and those that ultimately control the supply chains and control their own data are going to thrive. But I think that companies, this is ultimately a move towards building resilience. But I think it also is just a representation of the sort of deglobalization trend that we've seen in place. And it almost feels a little bit like a tech Cold War, Jake, when you hear about these things and what
Tech
direction things
Cold
are going to go.
War?
Yeah, it seems like it. I mean, it's a tick. You know how many people use TikTok in our country
I don't know. How
and around the
many?
world? The numbers are
How many?
huge. They're just
How many?
absolutely huge. I don't know. I don't have them, but they're huge. I know, because I've looked
A
at them
lot.
before, but I'm not going to make up a number right now.
There's a lot.
Yeah,
Probably
there's a ton of
billions, right?
users.
It's billions, right? I'm sure.
Yes. Yeah, absolutely. But I think that from an investment standpoint too, right? There we've seen globalization, but we're also seeing that changing in real time. And that is also a reason that I think, having an actively managed portfolio makes a lot of sense versus just doing what people think has always worked.
Yeah, good. Apple's manufacturing momentum. So,
Mm.
Corey, have you gotten the new iPhone yet?
No, I
iPhone
have not.
17 Pro.
No.
Are you going to get it?
No, I don't think so.
So it's got this new thing. I don't have it yet either. It's got this new thing called the plateau. Have you seen that on the back?
Hmm.
Where it's basically it's flat and then it's got this plateau. Camera's supposed to be better. I think it's actually a different iPhone than basically just small iterations of the current one.
Hmm.
I think I've got the iPhone 13,
Hmm.
so I'm getting close. What do you have?
I think I have the 16. I got it 2
Oh, you
years
don't
ago.
need the 17.
That's why I was
Then
like, yeah, I don't
you
need
don't
it. I
need
got
it.
it. I got a new one about 2 years ago.
So my battery and Rachel's. We shouldn't buy phones at the same time because then I get dinged twice.
Yeah, that's what Cassie and I do too.
Yeah, we shouldn't do that. Or maybe I need to go in there and haggle and see if I can get 2 for 1 or something. But so, anyways, I don't know. I might need to get it because my battery drains pretty quickly. I think that's Apple's conspiracy, but that's another topic. Let's talk about their manufacturing momentum. So the CEO Tim Cook announced a $600 billion investment to expand domestic manufacturing, supporting 79 U.S. factories over 4 years. The initiative includes a new manufacturing academy in Detroit and partnerships with firms like Corning. So this matters to our audience, Corey, because this is a major vote of confidence in American industry. And it could create jobs, or I would assume it would, boost local economies like Detroit's and reshape supply chains. So my take, Corey, and I want to hear yours, is that Apple's playing the long game here over 4 years, 600 billion bucks. And to me, it's not just about iPhones, it's about they're building infrastructure here, education and economic leadership. And so for investors, it's a bullish signal for industrials and domestic tech suppliers. But again, I wouldn't shift your portfolio based on this news or even the show. But I just think I don't know if this is from Trump leaning on these companies and the fear of tariffs or what's going on here, Corey. But I'm curious, what's your opinion?
Yeah, I think it's a bright spot. I think it, strengthens U.S. industry. I think Apple is planting a flag, to your point, Jake. And they're not doing it out of charity, right? They're doing this because they see the writing on the
Sure,
wall. And I think
sure.
that back to the point we were just making about TikTok as well, how aligned these are. They know the geopolitical tide right now, right? Build at home, own your supply chain, de-risk from China. But I think that it is a bet on America, to your point, Jake. And I think that the strongest companies are going to adapt, and companies that don't adapt are going to struggle. But Apple is loudly and clearly adapting right now, and I
Good.
do
All
think it's
right,
a
Corey.
positive for America.
Good. What's our next topic?
All right, Jake. Trump targets quarterly reports. Last week, President Trump proposed shifting corporate earnings reporting from quarterly to semi-annual, arguing it would reduce costs and allow leaders to focus on longer-term strategy. Critics of this warn that it could reduce transparency and hinder investor decision making. The change would require SEC approval, where a Republican majority could accelerate the process. So let me just cover, Jake, I think why this matters. I think that if this does happen, market volatility could rise around fewer data points. Less visibility, I would think, could result in more surprises. I think it could ultimately benefit long-term investors, but I think that this is an interesting topic, Jake, and I'd love to hear
So
your take on it.
are you for or against it? I don't. You're too neutral. What are you? What's your opinion? Give me your opinion.
Yeah, my opinion is that I've struggled with this one, Jake. I've really struggled to kind of take a stand on this one or to take a
You don't
side.
have one?
No, I think that here's what I think. I think it sounds good on paper to let companies focus on the longer term, but I think that less disclosure and less transparency, I struggle to see how that's going to be a positive.
Yeah, I think this is a move in the wrong direction, actually.
Yeah,
I think making it semi-annual, like you said, it kind of will make it more volatile and make those numbers have more weight.
I would think so.
I almost think it's almost like when we first started, believe it or not, in this industry. Remember when our clients couldn't pull up their performance online?
Yeah.
Like they literally had to call us to get their performance, or we would print and mail them their performance, but they literally couldn't get it. Right? Isn't that right? I don't think they could get it on the internet.
Yep.
And my argument was when we did have that capability, I wanted all my clients to have access to their performance every day because I feel like the more often you look at something, the less anxiety it produces, right? Because if you're looking at your performance every single day, yeah, there'll be some spikes and there'll be some drops, but you get more used to that. Whereas if I just and now some clients still only want to look at their performance when they meet with us, and that's fine. But my point is, for those that are making decisions or get anxious, more data points I think are better than less data points.
Right.
Now I heard on the news, I think I heard on CNBC, Corey, that I forget, I might get this wrong, but I think they said that it might not apply to all companies. So they might say, I think it was smaller companies would have to do it more often and larger companies would be less often, or vice versa. So the point is there might be a capitalization requirement based on your size. But the argument is, like, you had companies like Enron, like they probably could have got away with their fraud longer if they weren't reporting. So again, I think transparency, I think they should have their reporting more often, monthly. Now maybe they don't need to do an earnings call, but I think if you had more dots on the data chart, then investors actually could see a trend, and you wouldn't have this. I think you'd have less volatility, and you could make more informed decisions, because I think these CEOs would get tired of doing it, so they would just report the facts every month, and that's
Right.
what we would care about. And so I'm actually against this. I think they should report more often. I don't think I think quarterly is okay. I'm okay with quarterly, but if anything, I don't think you need to force them to do it more often. I just think forcing them to do it less often, I think that's a move in the wrong direction. I think that would be a bad decision if it comes into fruition. But we'll see what happens.
Yep.
So
Yeah, that's good. I think I've taken my stance, Jake, and I agree.
I convinced you.
I agree with you. That's the way I've been leaning, but I've been really trying to keep an open mind about this, because I've been asking myself the question of who benefits from this.
Well, I do like the stance that people won't try to make drastic changes in their portfolio every quarter. However, I don't think that's happening. I could be wrong. I don't think people are doing that. I don't think the do-it-yourselfers are drastically changing their portfolio every quarter. Maybe I'm sure some of them are, but I don't think that's a big enough problem to mandate it to semi-annually. I think people investing in stocks should be wise enough to know that stocks are for the long run, no matter when earnings are reported. It shouldn't matter.
Great point.
Yep,
I agree.
You should make your decision on the quarterly or semi-annual number, unless something drastic's changed. But again, if something drastic gets reported, that should be reported regardless of earnings. Like Oracle's been in the news lately, but I mean, again, they had an earnings deal, but they're in the news. You just talked about them with TikTok. Like, they're reporting stuff and they're making news and doing press releases all the time, I feel like. So
what's interesting though is that it's like how often earnings are reported. What would be more interesting to see reform around, Jake, is the way that companies give forward guidance, the ways that companies adjust their earnings, all of the different accounting practices and levers that companies can pull. Like, that's what can really shift things right now, right? Somebody can report something and then their quarterly earnings can be totally different. But yeah, I think that focusing on the long term, what happens on a quarter to quarter basis, shouldn't matter quite so much.
Right.
But I agree with you that less transparency is probably not a good thing.
That's good. So as a quick wrap up here, the Fed still is driving a lot of things. So I'm watching the next Fed move like a hawk. Rate cuts are powerful. So you just have to be aware of that. And that's another reason to stay invested, because you can't time the market. You don't know what the Fed's going to do. Nobody does. And so, that's a good wrap of our show. Corey, you got anything personal you want to share with our audience as we wind down today's episode?
Yeah, Jake, I just returned from our first trip away from the baby. We had a long weekend in Sonoma, California. It went pretty well.
Was there some emotional discomfort?
Yeah, up until
being away from your child. You left your newborn child to go drink wine, Corey?
That's right. Yeah, 15 months.
Wow.
I felt like it was a healthy break. It was a healthy break, but there was some emotion leading up to it. But we left her at home with my parents. They actually came over and stayed at my house and stayed.
They obviously know how to raise a kid or two.
That's right. Here I said recording this with you, but I was proud of them, appreciated them doing that. I think I was proud of Cassie and myself too. It would be easy to not do that.
Did they stay at your house? Did they stay at your house, or did they stayed at your house?
They stayed at our house.
Wow. Did your parents sleep in your bed?
No, they slept in a guest bedroom.
Okay. Yeah, I think that'd be a
good question. Yeah, they slept in a guest bedroom.
I was just curious, like, if you're gonna have to take all the baby stuff, your newborn, you just had a baby and you left it.
Yeah, 15 months ago.
Just kidding. Isn't she 18 months? She's a year and a half old.
Yeah.
So you went to Sonoma to see a client with your
see a few clients
also,
actually.
Drink all. So when are you go to your parents though? When are you gonna go on vacation with your parents now for doing what they did?
Yeah, that's a good question. We need to get that one on the books. We don't have
All
anything
right.
planned right now.
All right, real quick for our audience, you can give this recommendation. It's not an investment tip. Do you have a wine that you really, what was your favorite wine that you tasted while you were up there?
Yeah, there was a wine that was called the Mariner. That was the name of the. It was like a red blend at a vineyard called Dry Creek. Well, they all have a story behind them, right? So that
Dry
was
Creek?
yeah, Dry Creek. There's a Dry Creek Valley where there's a bunch of vineyards that are in Dry Creek.
So Mariner is in Dry Creek Valley? Is that what you're saying?
No, there is a Dry Creek vineyard in Dry Creek Valley, and Dry Creek Vineyard makes a red blend called the Mariner, and that was my favorite that I
Called
had
the
while we were
Mariner.
out
And
there.
I'm joking about the name Mariner's. Isn't a mariner a ship? Something
Hmm.
to do with water?
Yep, the captain. I think it's the
Is
captain.
that what
That was
Mariner's a
kind of the
captain
story
of a
behind
ship?
it. Yeah. There was a
So that was your
mariner and then a
favorite.
mariness.
Ah, but that was your favorite wine
Yeah,
on this
I
trip.
think that was my favorite that I had this trip. It was a red blend.
Okay.
And it's great, Jake. The
Good.
hotel that we stayed at, we were able to accumulate a few bottles from different places and then just fill out a form at the hotel and then ship everything back home.
Nice. Yeah, they make it easy to spend money out there. That's
They sure
good.
do. They sure do.
I had some of the best mozzarella I've ever had in my life in Sonoma or wherever we were.
Yeah.
Really good mozzarella up there for whatever reason. All right. Personal Rex for me. I'm listening to Stocks for the Long Run. Shame on me. It took me so long to read this book or listen to it by Jeremy Siegel, who I think is one of the premier guys. I'm really enjoying it. I think I'm like almost 2 hours in, 13 hours listening. So it's really good. I highly recommend that for anyone that's a geek about finance like I am. Any financial professional should probably read. I've gone to Wharton, so I feel like I gotten the gist of it all already. But I'm really enjoying it. Are you reading this one with me, Corey? Are you in the
I
book
am.
club this time?
Yep, I'm
Have
reading
you
it. Although
started
I
it?
may be shifting to listening to it. I've
Yeah,
struggled a
listening.
little bit to get into the textbook nature of it. So I think listening
Yeah,
to it
it's
might be
huge.
great.
This sucker is like a dictionary.
Yeah.
So I highly encourage listening to it.
Let me
It's
ask
an
you a
easy to
question, Jake,
listen
before
to.
we wrap up.
Sure.
Unless you had more to go on about
Go
the book.
ahead.
I'm
No, I
sorry
don't
about
care.
that.
Go ahead.
I wanted to ask you the question of because I know it's coming up. In fact, you're hosting a little get together for this, the Ryder Cup. Who do you cheer for in the Ryder Cup, Jake? The United States or
Ooh.
Europe?
I was talking to Rachel
And
about this
why?
last night. So this is going to sound controversial, Corey. So I was looking at both the teams. And on the European team, there's only one player I don't like. I don't really like Terrell Hatton. I think he's a whiner. On the American team, there's several people I don't really like
Mm.
or root for. I don't like Cantley because he plays slow. I think Justin Thomas seems like a little bit of a jerk. I think a lot of them are jerks on the American team. Oh, I and Rachel, this is so funny. We're hosting a little patio party. We're breaking in our new patio this weekend. And I got a screen from my tech guy, and we're going to watch the Ryder Cup on there. But it's so funny that me and Rachel are both rooting for Europe, Corey. I know that
Mm.
sounds horrible. I love America. Don't get me wrong. I love America. That's a great country. But to be fair, Corey, I'm not far from Europe. My mother is 100% Europe, German, born in Germany. So like, I feel like I have a right to root for Europe because I'm very close to being. I mean, who
I mean,
knows
you're
if my dad
100%
would have met my
American, but I hear you.
but if my dad would have met my mom in Germany, I could have been born in Germany. So I'm really close to being European. Is my point. I'm much closer than Rachel. Rachel's family is like goes way back to like I think she's a daughter of the American Revolution. Like she's as American as you can get. I think other than being maybe Native American, she's like American, right? So she doesn't have an excuse. I do. Um,
But you're
but
both cheering against America. Got it.
I wouldn't say against America. I'm
You
more
wouldn't?
cheering for Europe. I'm
Oh,
cheering for Europe, not necessarily against America. I love America. Don't get me wrong. But I can't help it. I
that's
like the
fair.
Euros. I like Justin Rose a lot. Big fan of him. I like Rory, even though he's a whiner. I like Rory. So we'll see. Hopefully, it's a close match. The home team typically dominates. I think Europe won last time. And so we'll see. It's going to be in New York. So I think there's going to be a ton of heckling going on. So it should be entertaining TV. Hopefully, there's not, I mean, they got a little, hopefully, they don't get too many skirmish. Hopefully, it's good, clean fun and there's no controversy. But I'm looking for some good golf. I'm looking for some good golf. Bethpage Black, one of America's favorite public courses, public course in New York. I was watching last night too. The rough isn't very long. So I think they're making it so more birdies can happen, which will be a lot of fun and less bogeys. I think they're going to have more birdies and make it not as challenging as Bethpage usually is. So hopefully the pros aren't struggling and it's more of a par and birdie fest, which will be fun to watch.
All right.
How about you? You rooting for America?
I'll root for America. I'll root for
All
America.
right. Good luck.
All right.
I think
Same
the
to
Euros
you.
got it. I think they're going to win.
That's fair.
All right. That's all the time we have for today. Thanks for asking me that controversial question, Cory. And thank you all for tuning in. We hope you have a great week.
Thank you for listening to Upticks. Click the subscribe button to be notified when new episodes become available. Also, be sure to visit our website at www.falconwealthadvisors.com and click the Contact Us button if you'd like to meet with Jake and his team.